Thanks you for taking a few minutes to check out this video from a tradingplan.com. And what I'm going to show here is two trades. One was stupid, not a very smart move, and the second one was a whole lot better. First, I was at the market last night. I was looking for some swing trade setups, and I found one on the pound US dollar that I was pretty happy with. The only problem was the entry price was pretty high above areas where I'd put the stop. All right, so what I want to do with that trade is find a better risk to reward setup on that. Instead of using and appreciating what the market was showing me, I didn't. I made a big mistake, and I'll tell you what it is. First off, the entry should have been above this candle here, but I didn't like that. It had to travel all this far up this spike, and I wasn't a big fan of that. But when I saw these inside candles setting up here, I wanted to take a break of these to the upside. The high probability trade was, for me anyways, was to the upside. And my target was at the 200 level, 5200 level, which is actually a swing high level just off to the left of the chart here. So I can bring it over for you right there. Okay. And price didn't get that high, it got to 80. So what happened was I set this trade up and I put my stop in a stupid position. And I'll tell you why. I've been trading for a while, and I know a lot of you that are watching this video have traded for a while. We know that when we get these congestion areas like we see right here, right? What usually happens on these trades? You get a little poke through and then the move up, right? Clears out orders. So when we got all these big move up, there are a lot of people looking to go long here, right? The market's telling you that. People are looking for breakouts of here, right? So what are they doing? Putting their stop just below here. And what usually happens? We also have this area up here where you can see this candle up here. What usually happens? Price pokes you out. That's what happens, right? It's like I got kind of set up for this trade. Just stupid on my part. Because right through here we have this range of trading activity. See, price pops in, brings traders in and looking for the breakout, and then pushed up with some strength, right? Look at this candle. Starts coming back down, gets back into the range, pops these traders out that put their stop just below here. Hi, that's me. And then continues on its way. This happens all the time. I know it. You know it. My stop shouldn't have been there. But I wanted to adjust for a decent reward to risk, right? This trade was going to be a 9-9 reward, 30 risk, right? 3-to-1 reward to risk. That's what I wanted. But instead of looking and seeing what I was being faced with, right, what I see, right, I thought, okay, well, let me just put my stop here, and I got stopped out by 1 pip. If I would have dragged down to a lower time frame, see, if I put it way down here, the reward to risk, it was horrendous. So stopping at a 15-minute chart, let's see if there's anything else I could have used. Well, here's that range I showed you earlier. We got this area right down here, which is down around 20-ish, which makes it still a pretty lousy reward to risk. And about a 50 pip risk. You've got a 2-to-1 reward to risk ratio for a swing trade. Could do better than that, right? How about this area right here, 50.39? Well, if you look what we have here, we had the market spike up, go sideways, bust above. Market came back down. And what did it do? Tested this area right here on its way up, right? Basically the breakout, pullback, boom. All right, it's not a bad area, right? It's already been tested. So, better area? Well, let's take a look. So I lost 30 pips up at 70, right? My area would have been here, 50. So I'm looking, actually, sorry, this was a 50 pip. This is obviously a lot worse. Looking at about 50 pips, still 2-to-1. Is that good for you? Well, let's say it wasn't good for you. Let's drop down to a 5-minute chart. Let's see what we got. Well, okay, this is where we got taken out, right? So let's take a look below price. What do we have here? So the stop was around 50.70. Have the congestion here. There we go. 50.62. That's not bad. This one's not bad either, right? This is nice because look what happened. You had this candle here, which shows who's in charge. The bears are in charge, right? What happens to this candle? It takes out this high, signaling what? Nice move up, right? So if we take a look at this area, which I should have been doing earlier, right? This was the area of congestion, right? In this area right here. And there you go. Makes sense, right? Just looking at what the price was doing here. It's moving up, right? Big rejection candle here at the 80 level. Rejects. Breaks above that, signifying what? That the bulls are back in town, right? Would have been a lot better. Didn't do it. The trade never did get to the ultimate target anyhow, which was up here at 5,200, which, like I said before, was a spike level. And you know what? I'll be honest with you. I so wanted to get into this trade that I didn't even take a second to do what I know to do. You know, this is just I deserve to lose this trade. I was looking for this area right here for my profit target. In this range was a heck of a lot better because look at the spikes. If price would have gone all the way up here and closed here and turned, a little bit different, right? If the close of this candle was up in this area right here, which would have brought the open of this candle up here, a little bit better. Makes sense, right? But I was looking at 5,200 level for a psychological round number, right? Price usually gravitates to that area. Instead, I should have been a bit more onto what I was looking at here. But once again, I was so caught up in taking a pretty decent reward to risk trade that I had to find a way in this trade. Ultimately, I lost. And even if I would have got triggered into this trade, let's just drop down to an hour chart because there wasn't a whole lot. Got this move up here. It's getting rejected up in this area. I see this push up sideways. Then we start seeing these spikes on the top of these candles, right? Upper wicks, upper shadows are showing what the momentum's dying off. You know, I could have locked something in here and at the end of the day still, you know, did well in this trade. In the end, I lost 30 pips in this trade. Came around to earlier on, right now it's 12:11 I'm making this video. This is around 10:45-ish. This is a 15-minute chart. I was looking for the reversal. The system that I'm going to show eventually on this website, there was an entry here, and the entry is at 51.38. My target was down here at this low right here, right? This is just a quick little day trade. Could call it a scalp, what do you want to call it? But I'm not scalping at 10 points, 10 pips. I'm actually looking for about 26 reward. And you can see the market pops down here, takes me out for my profit, and moves back up. It didn't even put me underwater even for a second. So good trade. Now here's where the big thing comes in. When you're swing trading, generally you're going to have a bigger risk profile than you're going to have when you're day trading or scalping, right? For example, the swing trade was 30 pips in risk. This trade was 11 in risk, looking for a 26 reward, just a little bit better than 2-to-1, right? Reward to risk. But what happens is, if depending on how you position size, you use a percentage of your account, right? So let's just say, for math's sake, this first trade of the day, this 30 pips, let's say I was able to trade, trading 1% of my account or whatever, 2%, whatever it is, one mini lot, right? So I lost $30, right? Would have made 99. But the risk on this last trade of the day was 3 times smaller, right? With basically a 10 pip risk. So now I can actually position size to 3 mini lots. See what I'm saying? So the reward was 26 pips, right? Which equals $78. Lost $30 on the first trade. End the day with 48 minus spread costs, right? There you go. So I obviously it all depends on your position sizing, how you can do it, what your account size is. And I actually trade with Oanda, so I can position size right down to the pip, which is kind of great. Depending on how many units you could trade, you want to take 75,000 units, 76,000 units, doesn't matter, which is great. 100,000, 101,000, doesn't matter. That's why I like Oanda. Just got to be careful because when they widen their spreads around news time, it gets pretty crazy. But I've been trading with them for quite a long time, and I've had zero issues with this company. Anyhow, so that's that. End of the day positive, but I just wanted to show you that I made a stupid mistake, right? And I guess there's something to learn in there. You know what to do, just do it. But I was so caught up in that trade, and it was dumb. It did rally up for basically 80 pips. I would have got something on it, but my options were pretty much either take a worse reward to risk ratio on that trade or pass on it. There are my options. Anyhow, still bad news, good news day, right? And you can see the market starting to rally up now here, but I'm out. I'm flat, and that's that. So thanks for watching.